the insurance companies and the pension funds, they want long duration yield, right? That's what they want. The money markets, they want this very short duration liquidity credit spread. Everybody wants something different. The equity investors want leverage on some underlying business model. The derivative investors want that. Now, if you think about, think about the process of creating a piece of digital credit. What I think in my mind is, this is a block of plexiglass, or this is a block of acrylic. Just think like a big block of plastic that's a meter by a meter by a meter. And then I have a CAD/CAM system and a computer-generated machining, or a machine that's computer controlled, so I can operate the lathe and I can chip out anything I want from that block of plastic. So I put in whatever my image is, I unleash the computerized machine, and I get out some beautiful sculpture, right? Not quite 3D printing, but something like that. I'm converting a block of raw material into something, a beautiful work of art. And of course, what does the person want to see? How many different types of sculptures? There's infinite types of sculptures, and they're all just coming from a single block of some kind of acrylic or plastic. Now, I think about digital capital. It's like you have a bunch of digital capital. You have $1 billion of Bitcoin on your balance sheet. You can carve out any digital credit instrument you want, right? And credit instruments are varied. What's the degree of collateralization? Is it 10x over collateralized? What's the degree of liquidity? What's the credit guarantee? Can I get my money back in a year, in a decade, in a century? Is it perpetual? What kind of yield does it give me? What's the yield curve? Is it high duration yield? Here's the magic trick, right? You're a Japanese company. You want to create 5% yen, 5% yield in yen forever. How do I create that, right? Is there a market for that? Yes, there's like trillions of dollars of money markets in yen that get 50 basis points. So if I can carve out 500 basis points and I create this currency, I'm going to take the currency risk of the yen. I'm going to create this yield. I'm going to actually create duration forever. And what's the collateralization? Do you want 10 over collateralized, or 5 or 2? What kind of credit risk is going to be embedded in this instrument? I can actually sell you that instrument, and I can collateralize it 27-to-1. I can collateralize it 20-to-7-1 and give you a credit put, every 3 years, and I can completely change the nature of the credit. Or I can collateralize it 2-for-1. I can create sub-junk yield, right? And I can give you a different instrument. So when it comes to credit, you've got all sorts of investors. The Russians don't want US credit. The Chinese don't want US credit. The Japanese don't want US credit. The Canadians, the Europeans, they don't want to take credit, they don't take currency risk. So you can create a credit instrument, if you're a Bitcoin treasury company, in any currency, with any degree of duration, with any degree of collateralization, with any degree of volatility. I talked to a guy probably richer than everybody in this room, and he's got a bit of Bitcoin, and someone says, well, why do you only have like 1-2% of your portfolio in Bitcoin? He says, well, frankly, I'm like something years old, and I can't handle the vol. Okay, 75-year-old, 80-year-old guy with a lot of money, he just doesn't want a 50 vol, 50 ARR instrument that you have to hold for, if you call it indefinite duration, in theory it's 120 months. So if you're willing to hold this thing for 10 years, somewhere between 120 and 240 months, I'm pretty confident you get yourself like 30% a year ARR. But when you're 92 years old, who wants to actually hold something for the next 25 years? They don't want it. And so there are a lot of people, there are very wealthy pockets, and they can't stand the duration. They can't handle the volatility. Another example of people can't take the vol, corporate treasurer. You know, you've got a Bitcoin company, you believe in Bitcoin, but you got to make payroll and you need to make your rent. And so you have working capital. You know, conventional wisdom is keep 1 year of working capital into the currency that your liabilities are denominated in. That's your treasury. You're not going to put that in Bitcoin. You're going to put that in, right now you're going to put it in a money market. And in the US, it'll give you about 3% after tax. But in Japan, it's going to give you 25 basis points after tax. In Switzerland, it's going to give you minus 50 basis points. The entire yield curve in Switzerland is negative out to 4 years. In Europe, it's going to be 200 basis points, maybe. So you've got how much? 30, 40, 50 trillion dollars tied up in treasury instruments and money markets and the like between Japan, Europe, Switzerland, Canada, the US. 30 trillion in the US alone. They can't stand the vol. They want you to strip the vol. They want you to strip the interest or the yield duration off the instrument. Just give them pure spread. So what is the closest thing to kerosene that we can produce in this industry? It's basically pure yield. Something like we created with Stretch, it's like if you can just strip away the current, you know, I live in Japan and I like the 400 basis point treasury, but I can't stand the US dollar risk. I can't stand the currency risk. Strip away the currency risk, strip away the duration risk, strip away the volatility, strip away the credit risk, give me liquidity, right? Serve it up to me in some sort of credit instrument. And, you know, what? Take MetaPlanet, they're sitting on billions of dollars of Bitcoin. If they can open up the credit side of that trade and they can sell Meta yield at 5 or 6% in JPY, they'll be arbitraging 50% US dollar ARR versus 5% in the yen, and they capture the 45% spread. When you think about what is the opportunity here, everywhere in the world you need treasury companies. Why? Because you're creating the high quality credit. And what credit? Well, you can create that pure yield product and you can sell it direct retail, go to the retail like sort of we're doing. You could also create that product and partner with the largest bank in Switzerland and you could power their treasury. You know, well, B of A is running treasury for $1 trillion or something. So what if you actually power the treasury of another bank and you become a B2B player? So a company could pursue a strategy where they create the yield and they create the return or the credit instrument, but they sell it through a bank. Well, how many banks are there? 25,000 banks. There's 25,000 people to sell it to. Well, what else? Insurance companies and annuity companies. There's companies that have, you know, hundreds of billions of dollars and they're on the hook for annuities. Open up a pipe to the annuity company or the pension fund and you just sell the yield directly through. You could do that as well. Also the insurance business, right? And so when I look at this, people go, well, you know, how much room is there for Bitcoin treasury companies? That's like, you know, some dude says, why would you want to buy a hamburger on the Upper East Side for 40 bucks when I'll sell you a hamburger for $3 in Kansas? Well, because I don't live in Kansas. That's not, okay, well, so I guess there's room for one restaurant in New York. Well, what about the people downtown? What about the people who live in Tokyo that want to eat? Right? The truth is there's a lot of room for restaurants. There's a lot of room for how many banks? 5,000 banks in the US. There are 25,000 banks in the US 80 years ago or 100 years ago. So 100 years after they're obsolete, there's still 5,000 of them, right? There will be thousands and thousands of treasury companies. Just like there's thousands of insurance companies, thousands of funds, thousands of banks. And why will they exist? They will exist because the risk-free fiat credit rate is 50 basis points in Japan and minus 50 basis points in Switzerland and 200 basis points in Europe and 400 basis points in the US, going to 300 basis points soon. And the world wants 10%. Right? And who wants 10%? Everybody. Okay, so the real issue is, how are you going to wrap it? How are you going to construct it? I want it to run on my rails. You know, you can buy Stretch on NASDAQ brokerage, but you can't buy Stretch on Robinhood. Okay? How do you get the security to go down the rail? It's kind of like, yeah, I got a hamburger, it's $3, but how do I buy it in London when the hamburger is getting served up in San Francisco? The distribution matters, the container matters, the compliance matters. The marketing matters, right? I mean, do they like you? Do they trust you? So, you know, when I think about Bitcoin treasury companies, I'm like, well, do you have the management team? Do you have a strategy? There's 1,000 strategies, 1,000 ways to do this. Do you have a focus? Do you have a capital market, right? Orange BTC is coming public in Brazil. They'll be the first company that's where the capital structure has been designed to be elastic to support ATMs and the like in that capital market. So constructing the company with the strategy in the right capital market is important. But you know, it goes without saying there's going to be a monster treasury company in every capital market. It won't be us in Japan. It'll be Metaplanet, most likely. Right? There'll be a monster in every capital market, but that doesn't mean there isn't room for 100 other very successful companies in every major capital market. You ask the question, how much capital is there? How much financial repression is there? Right? And yeah, I'm not going to go and issue credit instruments in Turkey because the rate's like 46% or something. I'm not going to go there first. I'm going to go and issue credit instruments, you know, where a 10% seems like a screaming home run, and 10% against a 30% ARR over 20 years, it works out to about 90% of the economics go to the issuer. So I would just say the business is going to explode. There's going to be 1,000 ways to win. We're in year one. Don't listen to the critics and the whiners. Think about the critics of the petroleum industry in 1866 and put yourself in the place of the entrepreneurs and ask yourself, would you get dejected when the price of crude oil traded down 35% and people told you it's a crap business? Because that's exactly what happened to Rockefeller, and what distinguished him is he just always believed that it was going to work, and when everybody else was selling, he was buying, and when they were buying, he was buying. And when everybody was whining, he was building. And when everybody said, you know, in 1909 or whatever, when the entire industry was mature, right, that's when the automobile got invented, and it got 10 times bigger. So this thing is going to be big. There's no reason that credit, digital credit, you know, the credit on gold became bigger than the gold supply. The digital credit may be bigger than the Bitcoin network. If Bitcoin goes to 100 trillion or 200 trillion, there could be 200 trillion of credit on top of it. You know, you may not want to issue it. That's up to you. Someone will want to buy it. You know, and that is the future that the market will determine. And the market is 100 industries, 100 capital markets, and your job as a Bitcoin treasury company, solve the problem, solve the compliance problem, solve the tax problem, solve the issuance problem, solve the credit problem, do the marketing, do the product design, solve the distribution problem, evangelize the future of digital capital and digital credit, and roll with the punches. Right? Don't get liquidated on volatility. You know, build the most robust structure you can. But otherwise, we are all, you know, if the Bitcoin miners are the first line of electric defense or computational defense of the Bitcoin network, Bitcoin treasury companies are the first line of economic defense. They're the ones that are going to spread the entire ideology of digital capital, of perfect money,